you are earning over $1 million a year, and at that level, every dollar you give or keep is a strategic choice. This isn't about dodging taxes. It's about redirecting your money so it supports your vision instead of it just funding the IRS philosophy. When used right, is one of the last remaining levers the wealthy can put to meaningful lower taxes while building a legacy. Why this matters to you? When you cross into seven-figure income, most deductions disappear. You lose child tax credit, you phase out itemized deductions, and the AMT or sub taxes creep in. But giving, when done strategically, can cut your taxable income by hundreds of thousands, create family legacy funds, and give you control over where your money goes. This isn't about being generous, it's about leverage. If you're going to give, do it in a way that also strengthens your balance sheet and reduce your tax drag. What the law allows right now. So under the current IRS rules, if you give cash to qualify public charity, you can deduct up to 60% of your adjusted gross income, AGI, in 1 year. So if your AGI is 1.5 million, you could potentially deduct up to 900K. But anything above that, you will lose it. You can only carry it forward up to 5 years. For non-cash gift and stock or real estate, the deduction limit is usually 30% of your AGI, but you also avoid paying capital gain tax on the appreciation. So if you got a stock that's double, donating it gives you 2 wins, a deduction on its full value and no tax on the gain. Donor Advised Fund or DAFs make this easy. You can contribute assets now and take the deduction now, and then decide later where the money goes. So that gives you flexibility and control, both keys for high earner. Let's take Elise, a doctor who owns her own practice in New York. Her AGI for 2025 is about 1.8 million. She donates 400K of long-held ETF shares into a donor advised fund. Here's what happened. She avoided about 90K of capital gain tax she would owe if she sold those shares. She took a full deduction for a $400,000 gift, well within her 30% AGI limit for appreciated property. She funded a charitable account she can use for years to support causes she cared about without rushing to pick charity now. The end result, roughly 150K in federal tax saving and a long-term giving vehicle that grows over time. She turned her taxes into impact instead of just another check to the IRS. Now we go to a different section, how you can maximize your giving strategy. Step 1, decide how much you want to redirect. If your AGI is 1 million, ask yourself, would I rather give 100K to a cause I choose or lose it in tax? You are paying that money either way. The difference is who benefits. Step 2, pick the right vehicle. So cash gifts are simple but not always optimal. Appreciated assets or donor advised fund often create more saving and long-term flexibility. If your giving goal is multi-generational, explore a private foundation or a charitable trust. Third, time your giving strategically. If you are about to sell a business, exercise stock options, or realize big gains, give before the event. That locks in deduction and prevents tax on the appreciation. Step 4, keep records. Always get written acknowledgement for gifts over $250 and for non-cash gifts over $5,000. If a qualified appraisal is needed for the non-cash gift, and file Form 8283 with your tax return. High earners attract IRS scrutiny, documentation protects your deduction. Let's talk about another section. It's planning beyond 2026. So the current 60% limit and high estate exemption, which is around $15 million, right, because of the big beautiful tax bill. So if your goal is legacy, consider private foundations, more control, more paperwork, but you decide everything. You can look at charitable remainder trusts or CRTs, donate appreciated assets, defer gains, receive annual income for life, and leave what's left to the charity. You can also look at charitable lead trust. With charity gets income now, your heirs inherit later at a reduced estate value. These vehicles aren't just about tax. They are about shaping how your money lives on after you. Let's come to another section we want to share with you. You can blend your giving with business. If you own an S corporation or a partnership, your entity can make charitable contributions that flow through to you. It won't double your deduction, but it can simplify bookkeeping and align your brand with your value. For example, your business can sponsor scholarships, community programs, or local nonprofits, and you get both a tax deduction and a stronger goodwill. For C corporations, charitable contributions are limited to 10% of taxable income, but still valuable for brand building and employee engagement. Let's look at the big picture. When you earn 7 figures, you already master how to make money. Now it's about mastering how to keep it and where it goes. Charitable planning isn't just for billionaire or family offices. It's for anyone who wants to decide, do I want to send this dollar to Washington, or do I want to send it somewhere that actually matters to me? Every dollar you give intentionally reduces your tax bill and increases your legacy. In 2025, the most strategic high earner won't just donate. They will engineer their giving to shape their future. Thank you for watching. I'm Mia. I will see you at the next video update.